let's go to chapter 10. Okay, remember I said in your classified balance sheet, the first one was current asset, which we already covered previously in here, you see? Okay, chapter 5 through 8, we covered current asset. In chapter 9 was long-term investment, second category of classified balance sheet. Perfect. In the third category of classified balance sheet, we're going to go in chapter 10 and 11 and talk about the third category of classified balance sheet, which is property, plant, and equipment. And down the road, at the end, the fourth category of classified balance sheet in chapter 11, which is intangibles. Okay. So let's go to chapter 10. We're gonna go over 3 and then leave the other 3 part for later. So let's go to measurement of cost. So what costs are included in PP&E? Those are things that you use in your daily business, like land, where you have a building on it, you have employee parking, that's land, never depreciates. However, you have building for your office building, that is depreciating. So you have accumulated depreciation dash building for, for that building. So you know how much was the original cost and how much has been depreciated so far, and what is the net book value of your building. For the equipment, same thing again. You have equipment or machineries and less accumulated depreciation dash equipment, and that gives you the net equipment balance that still you will depreciate in future, and that if you add them up, it gives you the total PP&E like $4 million in this example. Any question about PP&E? In regards to spending money, there is 2 ways you can spend money. One of them is revenue expenditure. One of them is capital expenditure. Revenue expenditure means you spend money for daily business operation, utility expense, rent expense, insurance expense, daily business operation to generate revenue. However, we have a secondary expenditure also. So not revenue expenditure, but we call it capital expenditure. Capital expenditure is ordinary and necessary cost incurred to place an item of property, plant, and equipment in its conditions for intended use. Such amounts are included in the asset account as a form of PP&E, property, plant, and equipment, and you capitalize them and you depreciate them for the next useful life of the next few years of useful life of that property. So capital expenditure, that means expenditure that you capitalize them and then you expense them using a depreciation expense, let's say, for the next coming useful years. So when you purchase an equipment, you record it as equipment, you don't call it expense. You just call it asset, equipment, that's it. And that's a debit on your asset to increase it. If while you are installing it, you break a portion of that equipment because of your carelessness, that's a repair expense. So that's not equipment. But if you pay for foundation to put that equipment down, if you pay for sales tax, if you pay for delivery, pay for installation, pay for testing, all those things will be capitalized, combined $86,000. However, the $2,000 mistake and mishandling of the equipment, that's called maintenance or repair expense. Here says interest paid to finance the purchase of property, plant, and equipment will be expensed in its annual basis. Okay. However, it says if you borrow money to construct for construction of plant and equipment, during the time that you are constructing that interest will be capitalized and will be part of the equipment, like $86,000 here we are talking. Make sense? However, as soon as the construction is complete and still you owe money and still you have to pay interest, any interest after completion of the construction of the plant or equipment, then it has to be recognized as interest expense year after year. Land never depreciates. However, land improvement will depreciate. Land improvements includes the cost of parking lot, sidewalks, landscaping, irrigation system, lighting for your parking lot. All those expenditures are land improvements. You need to add them up. You need to recognize them in a separate T account, and you have to depreciate them because they are depreciable asset. However, land by itself, just the land, never depreciates. You have a separate T account for land, but never depreciates. Here you are talking about lump sum acquisition of an asset like a basket purchase. So that's a single price paid for a package of assets or basket purchase. The purchase price must be allocated to each of the components based on the weight. So let's say here you paid total $2 million to buy this, which is a little bit of land, a little bit of building on the land, and some equipment in the building. So you have to appraise them separately. Land ends up to be like $500,000. Building will end up to be $750,000, and the equipment ends up to be like fair market value $1.250. Total estimated value is $250,000. So, okay, but you paid how much? You paid $2 million. So if you use your calculator and so you say, okay, 2 million divided by 2.5 million, that gives me 80% weight. So everything is based on 80%. So 80% of 500, that the cost T account in the land will be $400,000. So you debit land for $400,000. 80% times 750 appraised value, that will be $600,000 in the building T account. 80% times 1.250 for equipment market value. You put $1 million in the equipment T account, and combined you pay $2 million cash. Yes. So $2 million cash credit, debit land 400,000, debit building 600,000, debit equipment $1 million. Cool. So this is what it's going to be. 3T accounts, and those are the values. That's the journal entry. Debit land, building, and equipment for those values that you calculated, and cash which has been credited. Materiality, it's an important matter in accounting for professional judgment. When amount involved are slight and it's not that much important to change the decision making of investors and creditors, so that will not necessarily need a proper adjustment or something because it's not material. But if something is material, then definitely needs to be disclosed or in some cases journalized. So we need to know what is the estimated useful life. It's the period that, you know, we think the asset will provide benefits, and we're going to depreciate based on that useful life of service. So we might use different ways of depreciation. One way you already learned, which is the straight line depreciation, which is total cost of the equipment, let's say, minus residual value, which is estimated, might be zero, might be something, whatever it is, divided by useful life. And that gives you straight line depreciation. And straight line depreciation, it's easier and very common between companies to do the bookkeeping and recognition of depreciation expense, including purchase price, sales tax, shipping, deliveries, installation, and testing. Combined will be total cost minus residual value, if any, estimated residual value, divided by useful life. And that gives you the annual depreciation based on straight line. However, which is very common, but besides those, you have two other options also, units of output and double declining. Straight line method is also used in tax purposes, tax accounting. So it is an option available under tax rules, and you can use straight line method. Under tax rules, there is also one which is very common. It's makers using double declining balance method. Makers, it is modified accelerated cost recovery system under tax rules. But we have under makers, you can also have the option to use straight line. So straight line is available under makers. Regular double declining is available under makers. However, units of output, it does not exist under tax purposes. So if you use straight line or double declining, it will be almost same as your tax depreciation. And you don't need to do some adjustments in your books compared to your taxes. But if you use units of output, then definitely tax depreciation expense will be different than your book depreciation expense. Units of output is based on how many units do you use for that specific product, like equipment. So under straight line, every year, your depreciation expense is the same amount. There's no change. But the maintenance cost, normally year one, there is no maintenance. In year 2 and 3, the maintenance cost will be higher. So as you see, in coming years, your total expense in year 1 will be less than year 2 and less than year 3, obviously, because of combination of depreciation expense and normal wear and tear maintenance expense. But in accelerated method of depreciation, double declining method specifically, you're gonna depreciate much larger amount in year 1 and year 2 and less amount in year 3 and 4. And when you combine with your regular maintenance cost, your average cost in your income statement will be about the same, because let's say you have big depreciation expense in year 1 and larger maintenance expense in year 2, 3, and 4. Residual value, we learned already, that's amount expected or estimated to be realized at the end of the asset's service life, and you also call it salvage value. The amount that you might be able to sell the asset at the end of useful life in free market. Depreciable base is the cost, total cost, minus salvage value. That will be depreciable base. Depreciable base divided by useful life will give you the annual depreciation under straight line method. So here is a building. Let's say the cost is $2.3 million, including broker fees, escrow fees, and actual cost of building, minus accumulated depreciation so far up to $1.5 million. So the book value of the building at the end of the year is $800,000. If you sell this building at this time, anything above 800 will be considered as a gain on sale of building. Anything below 800 will be considered as loss on sale of building. So above 800, you have a gain. Below 800, if sold, it will be a loss. Remember, when you buy a building, the building by itself, it is a land and building combined. So in that case, you have to appraise the land separately and put it in the T account for the land, and then appraise the building separately and put that in the building area. So you have to understand that you buy a basket of building and land combined. However, you have to separate that total cost into 2 T accounts, which is a little bit in the land and a little bit in the building. Land never depreciates. However, the building will depreciate. So depreciable base here is like 2 million. So the cost is 2.3 million, let's say, and you believe about 300,000 will be the residual value of the building after 20 years of, let's say, useful life. And in that case, your depreciable base will be $2 million. You can even estimate the salvage value might be 0. You can estimate that. Under tax purposes, that's normally what you do. You just estimate that salvage value is 0, and you try to depreciate every dollar of that investment in the equipment or building. So you might do the same thing. If there is no question, let me move on to the next page. So under straight line method, you know the cost should be deducted by salvage value. So cost minus salvage value divided by useful life. It gives you the same depreciation expense year after year. And accumulated depreciation we at the end of year one will be 22,500. Then year two, you add another 22,500. Year three, add another 22,500 to the point that accumulated depreciation ends up to be $90,000. And that's exactly the depreciable base, which is cost minus residual value. So when you get to accumulated depreciation of $90,000, that's where you stop. You don't depreciate anymore because you were estimating there is a $10,000 salvage value, and that salvage value estimated will not be depreciated anymore. And this is how you journalize the depreciation expense, which you know already. Depreciation expense will be debit, and accumulated depreciation will be credited. And the book value for the equipment after a few years, if you have, let's say in this example, some accumulated depreciation, then your book value will be, let's say, 32,500. After, let's say, 30 years of depreciation.
I have a question.
Yeah.
So if something is fully depreciated, then it's your 100,000 less 100,000, your net book value is zero. Do you continue to show that as an asset on your balance sheet?
Yes. So in your balance sheet, you will see equipment $100,000 less accumulated depreciation of $100,000, net book value zero. However, this shows in the balance sheet still. Even though its book value is zero, but in the balance sheet, I can see that still this company has the equipment that has been already fully depreciated and it's still using it. Let's say in my case, I had two heavy duty trucks in my business previously, and I depreciated my trucks all the way to zero. And then after that, for many years, still I was showing that in my balance sheet, but book value is zero, but still I'm driving it, so that's fine. So I keep using it, but I don't have anything to recognize as a form of depreciation expense. Until one day, finally, that's what happened. Until one day, I sold my trucks. And then at that point, let's say I sold it for $5,000 each. So two trucks sold $5,000 each. So I show that my book value is zero. I got $5,000 cash. That means I have $5,000 gain because my book value is zero. I recognize the gain. I pay taxes for that gain. And also I cleared those two trucks from my balance sheet at that point. Good question. So what is this saying? This is saying, how about if you purchase, let's say, the asset, not exactly on January 1st, but you buy it somewhere, let's say on April 1st, let's say. So you used it for 9 months out of 12. So in that case, in year one, you depreciate just a portion of the asset for that 9 months, 9 out of 12. So then you keep depreciating for year 2, 3, and 4 full amount regularly for 12 months. Then automatically you end up by have a depreciation to recognize at year 5 based on the 3 months left over. And that's it. So instead of 4 years, you go 5 years because of that. And this is the spreadsheet that you have saved in your flash drive. This is a schedule of the depreciation And this is how you formulate the function. And here is the function says SLN, which is straight line depreciation. You show the cost somewhere in the Excel sheet, if you like that way, and then say equals to that cost. And then you might put also, let's say, the dollar amount, date of the purchase, everything in that top section area. So you say equals to cost equals to 100,000. Salvage value, again, you can put it somewhere here, say salvage equals to 10,000, and then say equals to that box, enter. And then life, you can here put life, useful life, equal, and here 4 years, and then go to this box, say equals to that box, which is 4, enter. And then those 3 numbers will pop up. Or you can just type it in if you like to type. And but I like to have it in here so kind of visually see it all the time, what was used in order to get this calculation done. So as soon as you put this and you click OK, you see the formula results is 22,500. It will pop up in every single cell. But how about if you use units of output, then you have to estimate how many hours or how many miles this equipment or truck, how many miles it's gonna run. Let's say 100,000 miles or whatever machine hours if you have hours to use. So in that case, you have to calculate what is the cost per usage. And you have to know also the useful life. And you have to know what is the estimated salvage value. So in order to calculate that, so let's read this. It says the company purchased an air filtration system that has life of 8 hours. So this is the life in hours, machine hours. Okay, the filter cost, that's the original cost, 100,000, and the salvage value is estimated to be 10,000. So you have all this information, and then you have to here 100,000 minus 10,000 salvage value gives you the estimated, gives you the depreciable base. So cost minus estimated salvage value gives you the depreciable base, which is $90,000. $90,000 divided by 8,000 hours. How much is that? Let's see. Do we have that calculation somewhere here? No. Anyway, let's see. So $90,000 depreciable base divided by 8,000 hours. That gives me $11.25 per hour of use. And $11.25 per hour of use multiplied by 1,000 hours used in year 1. And all of a sudden, your depreciation expense will be $11,250. Or you can use the way your book is doing and say, okay, 100,000 minus 10,000 is the depreciable base of 90,000 times 1,000 hours used out of 8,000 hours total possible use. So that gives you a fraction. And that multiplied by $90,000, that gives you $11,250. Okay. Or use the way I did. I said 90,000 divided by 8,000 hours gives you $11.25 per hour of use, and then multiply that $11.25 times usage. If you use 30,000 hours, then $11.25 times 3,000. If next year you use 2,000 hours, then multiply that by $11.25. So every year your depreciation expense will be higher or lower. Depends on your activity. And this matches some way, somehow with your revenue, because if you drive less or use less, then technically you have less revenue also. If you use more in that year, then probably your revenue is also more in that year. So this kind of depreciation is good to match with your revenue properly and provide you proper amount of net income that makes more sense in a real story of daily operation. But now be careful on this next sentence I'm going to tell you, because no one tells you that. It's not written anywhere anyway. So, but you need to remember that. And here we go. Ready? Under straight line method or any other, let's say units of production method or any other method besides double declining, you need to use and calculate, use the salvage value in your calculation of depreciation expense immediately. So here you see, you need salvage value. Under straight line method, you immediately need salvage value, okay? But double declining method is the only method that you do not need to use your salvage value at the beginning of calculation whatsoever. So the only moment that you probably will need to know the salvage value, it is where you get very close to the end of useful life. At that point, you need to remember that never depreciate your asset below estimated salvage value. So that's the only moment you need, close to the end of the useful life. You need to remember, never depreciate below salvage value. So what is double declining? First of all, it's declining balance method. And then from declining balance method, double declining balance method is the most popular one. But the double declining, that means multiply by twice faster depreciation. Double declining is twice faster depreciation than salvage, than straight line depreciation. That's why you call it double declining. But we have 150% declining balance method. We have 125% declining balance method also available. But normally double declining balance method is the more popular one. And that's double declining balance method also is very common in tax depreciation. So how you do it in regards to calculation, let's see if it's showing here. Okay, I tell you. So this is how you do it. You say, okay, what is my total cost? You need to know that. And then you say, I'm gonna depreciate 100% of this asset, equipment, let's say. 100% of equipment divided by, let's say, 5 years life or 4 years life. 100% of equipment divided by 4 years life here in this example. So 100% of equipment divided by 4 years is 25%. 25% times double, here is where the double comes, times 2. 25% declining under straight line, which is, divide by 4. 100% of the equipment divided by 4 is 25%. 25% times 2 is 50%. So 50% is the rate of depreciation for you right there, 50%. So 50% of $100,000 asset is $50,000. Do you see anywhere here I'm talking about salvage value? No, you don't see that. On double declining is the only depreciation method that we do not talk about residual value or salvage value or use it somewhere in the calculation at the beginning. Okay, so 100% of the equipment, $100,000, let's say, the full cost times 50%, that's $50,000. But since we depreciated already $50,000, so $100,000 minus 50 gives me $50,000 left. $50,000 left to depreciate times 50% depreciation rate, that gives me $25,000. So 100,000 minus 50 minus 25 is 25. $25,000 times 50%, that's 12,500. So far, so good. Now, 12,500 is the depreciation expense. So 100,000 minus 50 minus 25 is 25 minus 12,500. That means 12,500 is left. Use your calculator. 12,500 times 0.5, which is 50%. That's $6,250. But remember, I told you, under double declining, the only moment that you need to know what your salvage value is at the end of the useful life, right? So in year 4, you're not gonna depreciate 6,250, even though 12,500 leftover times 50% is 6,250, but you are not going to do that. You are only going to consider and remember that the salvage value is 10,000. So out of this 12,500 left in the book value, if you can only deduct 2,500 and stop at $10,000 salvage value dollar amount, and you cannot depreciate more than that. So in year 4, you have to remember that, and you have to say, okay, 12,500 book value minus 10,000 salvage value, I can only deduct and depreciate 2,500 in year 4, and that will be it. And that will be total accumulated depreciation of $9,000. I cannot depreciate more than that whatsoever. So for the first 3 years, you are using mathematics, but for year 4, you need to remember that your salvage value is 10,000. You cannot go below that.
Professor?
Yes.
Is this, so if we get a problem like this on a test, it's just, and we know that we're using the double depreciation, we should just make a note maybe on the side about what the salvage is, so that when we get to the point where we're like, oh no, that amount's lower, that also would trigger it for us, right? Just to make a note of that.
Oh yeah, on your scratch paper right here on the right hand side, salvage value equals $10,000. Write it down just to remember. As I said, you never use it for your calculation, but you need to remember that for the last year in here. So in last year, already you depreciated 87,500 as you see in this calculation. Times 50%, that you think, oh, the correct answer is 6,250, and the answer is right there. I can see it in multiple choice. There you go. I know that. Choose that answer and move on. That's where you make a mistake, because you forgot to remember that the salvage value is 10,000, and you cannot push the book value below 10,000, your estimated salvage value. That's, yeah, so write it down somewhere.
Okay, so this is probably a dumb question, but I want to ask you anyway, because I need your insight, which is, I mean, what is the ultimate benefit? If you start a company and you buy equipment, what is the benefit to, you know, this accelerated depreciation? Is it because you get to write that off, or because it feel like it devalues your equipment sooner? even though it's not about evaluation?
Yeah. What it is depends on the situation. So let's say in my business, I never like to use double declining because in my business, I didn't have that much income. So having a big depreciation expense like $50,000 in year one in my business never make sense. I don't need that much because I don't have that much income anyway. So I prefer to use straight line method. But some companies, they have high amount of income and they bought this equipment, and this equipment, imagine this is a Cadillac, okay? Let's say this guy has a Uber business, and in an Uber business, he put a Cadillac to use as a Uber car. And the Cadillac is depreciating very fast in year 1 and 2 and 3, and less depreciation in after that. But year 1 and 2 is the big amount of depreciation for a car like Cadillac or Mercedes-Benz or any luxury car. But let's say if you have a Toyota in your business, Toyota is not going to depreciate fast. Toyota is depreciating more like a straight line method. So if you have a Toyota for your delivery of whatever you do in your business, then it's a good idea to depreciate it straight line method for your Toyota. But if you have a Cadillac, then it's a good idea to depreciate it straight line, double declining, because Cadillac is a luxury car and depreciates very fast. And if you have income to use such a big depreciation immediately in year 1 and 2, then why not? Then you have a Cadillac, you have a big income, then go with double declining. You depreciate faster, you have good amount of depreciation expense to deduct from your income and have lower income and then pay less taxes eventually. Depends. So in some cases, double declining makes sense. In some cases, it's not making sense. Depends on your business, nature of your business, nature of your income, how much revenue you have at that moment. Like if, for example, if I have a business that I told you I don't have big income, but happens to be in that year, I sold one of my trucks and I have a big gain on that. Okay, then I'm thinking, wait a moment, if I have a big gain, that means this year I'm going to end up by paying, a lot of taxes because of that gain. So how about this new truck that I bought it? How about if I use double declining balance method? So in double declining balance method, like this example, all of a sudden I will have $50,000 depreciation expense instead of straight line under will be 25,000, right? So I will have 50,000, which will be good idea because on the other side, I have a gain on sale of used truck, and that will wash my gain. Depreciation expense will wash my gain, and I end up by paying almost close to normal taxes that whatever I was paying last year. So it's a tax kind of a consideration always in your mind, how to manage your depreciation expense so you can manage your amount of taxes that you're going to pay.
That's a super good example. Thank you so much.
Sure.
I appreciate it. I get it. I really appreciate that.
Sure, no problem. So
I got another question.
Yes.
So let's say the salvage value was 20,000 in this example. Would that mean at year 3, when you've hit that 70, or year 2, you've hit the accumulated depreciation of 75,000? That means year 3 would be $5,000
Yes.
depreciation expense, and year 4 would be no depreciation expense, despite
Yes.
it still being used.
Yeah, perfect. So if your estimated salvage value is 20,000 for some reason, then in year 3, all you can depreciate, no matter what the calculation is saying here, doesn't matter. Year 3 depreciation will be only $5,000. So you depreciate 5,000, your accumulated depreciation ends up to be $80,000 in here, and you stop in year 4, 0 depreciation, and again, still your accumulated depreciation will still be $80,000. Yeah.
Cool. Thank you.
Under tax, depreciation, double declining is almost the same thing. The only good thing about tax is in the IRS provided publication, you have the schedule rate. The rate is given. So you see here is always 50%, 50%, 50%, 50%. Okay, this is because the reason this 50 is always 50, because you are smart enough to know that, okay, the beginning is 100,000, the next one is 100 minus 50, and the next one is 100 minus 75. That's why the 50, 50, 50 is always constant. However, in IRS provided table, you will see that here is, let's say, I believe, what, 32%, for example, and then something else in here and another rate in here. The reason there is different rates given in the IRS table, don't think, oh, this is totally different than this. No, in the IRS, it says you always use $100,000 as a constant. So if you use $100,000 all the time as a constant, then you will have a rate in here, another rate there, another rate there, and those rates are constantly changing. Makes sense? So, but here you have to be smart. You have to say, okay, this is 100, but this one is 100 minus 50, and the other one is 100 minus 75. By doing that, then yes, you can keep that 50, 50, 50 as you see in this. So just you learn this for now, but if you take the tax class one day, then you will see the other side of the same calculation. So what you do is this. I said 100% of the equipment, 100% of the equipment divided by 4 years life gives you 25%. 25% times double declining, which is number 2, it gives you 50% rate, and that's how you calculate the rate. And this is the spreadsheet again. So as soon as you go to DDB function in your Excel document, that will give you this window, and then you enter the information inside. And it will calculate the depreciation using Excel. Let's say for year 3, your depreciation will be 12,500. If it's year 4, you enter here period 4, and if you enter period 4 here, then the calculation ends up to be 2,500 automatically. The Excel will do it for you. And how about if it's you purchase somewhere in the middle of the year, let's say in April, so you will depreciate 100,000 times 50%, but times 9 out of 12 months for year 1, and that will automatically change your calculation down the road, because in year 2 you have 100,000 minus 37,500 times 50%. That gives you 31,250. And then in year 3 is 100,000 times 68,750, which is times 50%. That gives you 15,625. And then in year 4, you have to say, okay, 100,000 minus 84,375 comes up to some number, but you have to ignore it, because all you can recognize as an expense is only $5,625 and nothing more, because you have to stop when your accumulated depreciation is $90,000. So in year 4, you do just 5,625, and year 5, normally under straight line method, you have to do something in here, but there is nothing left to do under double declining, and you just leave it blank. Here it says alternative to double declining. There are other options too, which you might use it in some situations, like 150% declining balance method or 125% declining balance method. Those are a little bit less aggressive depreciation, but still a little bit more aggressive than straight line method. In regards to change in estimate, let's say change in estimate of useful life or change in estimate of salvage value, that's okay. You can change that estimate anytime you think it's appropriate. And if you change those estimates based on available book value of your equipment, you need to recalculate your depreciation expense from that moment forward. So you go prospectively forward, you never go retrospectively backward to change anything you did previously. You just go forward, and based on the new calculation, then you start doing that depreciation expense.
Professor, you just made me think about, you know how in the last year or two, the used car market has like spiked up in value, like that. This might be a situation where, you know, the value of your used vehicle, of your businesses have just all really have gone up really high. And in a situation like that, would you also need to do a depreciation reevaluation?
Yeah, you in that year, let's say, you say, okay, my estimated salvage value, let's say previously I was thinking $10,000. Now, based on the new economic situation, the estimated salvage value has changed to $15,000. Okay, and you also believe, after using this car, let's say for many years, you realize this is a very good car, and even your useful life previously you were thinking 4 years, but now you are thinking this is a Toyota and gonna go forever, and I think it's gonna be now at least 7 years. And so now your useful life is changed based on new estimate. Your salvage value is changed based on new estimate. So you say, okay, I'm in year 3. That's okay. So now, because the new life is 7 years, so I used 3. So 7 minus 3, 4 years left. And that will be from that point on, you say, okay, my useful life is 4 years. My salvage value is this much. So whatever the book value is left to depreciate minus salvage value, the new salvage value, divided by new useful life. Now my depreciation expense will be this much from now on forward.